All right, well, I won't keep you real long, but we're going to go through several things. One thing I made a comment on last week, I want to just make a change. I talked about that DSCR loan. That's the one where you can just use the income off the property to buy a piece of investment property. And I want to point out two things. Obviously, it's no income verification, none of that, but there's two very important factors. One is you have to own your current residence. It doesn't have to be paid for, it's just that you have to own, you have to be the homeowner of the current residence that you live in order to get this loan, in order to get that loan. Second thing is, I think I made a comment last week, you might be able to do it with 10% down. I've ran 3 scenarios this week, everybody's minimum 20% down. So that is going to be 20% down, not 10. So, but it is a good, what a way to buy a piece of property. Oh my gosh. 20% down, no income verification, as long as the property appraises. And when I say appraises, we got to get a 1007, which means it's going to do, the appraiser is going to income base that appraisal. Does the property make enough money to cover the mortgage payment? And if you want to get if you don't even want to do that, then you just have to put down 25%, but you got to have a credit score over 700. So there's some really cool things that you can do if you want to buy investment property. Again, interest rates are not for the weak of heart because they're going to be a little bit higher, but you can definitely do it.
What's the advantage of using that over just a regular loan to buy an investment property? Because that's still
none. I mean, there's no advantage to it. I would, if I were buying an investment property for me personally, I would go through the normal channels because I'm going to get a much better interest rate.
What is higher?
You could be paying. Let me give you a great.
Like
6
or 8 or
No. Here's going to be the difference. If I'm getting an investment property today, and I'm going to put down, let's just say I'm going to put down 25% of my investment property, I'm probably going to get a rate somewhere between 4 to 4.25. Okay, someplace in that ballpark. If I were to do that program, I'm probably going to get a rate someplace closer to 5 and have to pay at least 1 point origination and maybe a little bit of discount. So it's got higher cost and it's going to have a higher rate and it's going to have a prepayment penalty. If I just get a regular loan like Rip was asking, there's no prepayment penalty. But a lot of people can't afford it because when they look at their debt to income ratios and you put everything in place, they can't. So that this loan, they got high credit scores. Like the one lady I'm doing right now, she's got a 799 credit score. She's got her primary residence, she has one other rental property, and we're going to approve her for this, and she's going to go out buy another rental property, put down 20%, she'll get the house. She'll pay a higher interest rate. She really doesn't care because the rents are much higher than what her monthly payment will be, so the renter is the one that's going to be paying for it. So that's why she'll do it. All right. I want to jump into something else though today that is kind of a cool loan. It's called an asset-based loan. Now, an asset-based loan means that instead of using income to qualify you, we are going to use the assets, in other words, the money that you have sitting in checking, savings, investment accounts. It's got to be liquid assets. It can't be real estate assets. It's got to be liquid assets. We're going to use those assets to qualify you for the mortgage instead of using income.
So equity can't be used?
Equity cannot be used. No, it has to be liquid assets. So here's some, the first thing is minimum loan amount $250,000, maximum loan amount $3 million. It just sounds weird, but we're not going to check employment. We're not going to check income, which means we're not going to worry about debt to income ratios. A little odd, wouldn't you say? But that's the way it is. Now, but here's the catch. Only primary residents cannot use it for investment property. It's going to be a 30-year fixed rate loan, although there is an interest-only available option to it. It can be used on non-warrantable condos. So if you're buying, you mentioned Athens, if you're going to be buying property near a college town where a lot of the condos are non-warrantable, you can use it for that. The problem with those is most of them are not $250,000, so that loan doesn't work. It's, again, minimum loan amount $250,000. All right, here's the important part now. This is the assets. We've got to have liquid assets. So the first thing is that we are going to source those assets. So if they're sitting in cash, if you got, $1 million sitting in cash someplace, overseas or in your safe at home or in gold bullion or something of that nature, that doesn't count. Okay? We've got to be able to source where that money's coming from. So I tell everybody, make sure the money gets into some type of an investment account. If you got $1 million, I hope you're not sitting on it in your safe at home. Although there might be some crazy people that do stuff like that. So we have to source the money, which means it has to be your money. Rip wants to get this loan and says, hey, I've got $500,000, I can do this easily. And where Rip's getting that money from is he's getting it from his brother, and his brother says, don't worry, Rip, I've got the money, I'll just put it in your account. Rip goes, puts the money in his account. I'm looking at it and I'm saying, wait a minute, Rip, where'd this money come from? Rip says, well, that's none of your business. I said, well, it now is my business because you just put $500,000 in your account. We've got to source it. We're going to go back 6 months and look. So in normal financing, we look back 2 months. On this, we're going to look back 6 months. So you got to have the money in your accounts for 6 months. Some additional things. There has to be enough liquid assets to cover the entire loan amount. So we have somebody right now, like for example, I've got a lady right now. As a matter of fact, the lead came from someone here at C21. The lady's buying a $2.4 million property down in Miami. It's going to be her primary residence. Wonderful. They're going to put down 30, maybe 40%, which means they're going to have a loan amount of $1.5 million. So first of all, I have to source that they've got enough money to put that big of a down payment, which they do. Then they have to have enough money in the bank after this is over with, the starting point, this is not the ending point, to cover that entire $1.5 million loan. They got to have liquid assets. Now, that doesn't mean it's not in investments. They probably got it sitting in a lot of investment accounts, which is okay, whether it's Merrill Lynch, Charles Schwab, we don't care, but it's got to be in investment accounts. If it's in their retirement accounts, we can only use 60% of whatever's in their retirement account.
What counts as a retirement account?
401k IRAs.
403B too, I guess.
What's that?
403B.
403B, same thing.
Okay.
Same thing. So they've got to have enough. They've got to have the loan amount covered. The next thing we've got to have covered, we are going to look at their credit report, and we're going to look to see how much recurring monthly debt do they have. So let's just say that they have $1,000 a month of recurring month. Let's make it $2,000 a month. If they have $2,000 a month of recurring monthly debt, we're going to multiply that times 60. So 2,000 times 60 is $120,000. So in addition to having the $1.5 million to cover the loan, they got to have $120,000 because we're going to look at their recurring monthly debt times 60. So if they have $5,000 of recurring monthly debt, that gets to be a pretty big number. Now you're looking at $300,000. So again, this is not a loan for the weak of heart, but believe me, there's a lot of people out there with a lot of assets. So we're going to have, this is the way it works for them. They also have to have enough money to close. Obviously, the necessary down payment plus closing costs, prepaids, and escrow. Well, there's not going to be escrow, so. And then they have to have 6 months reserves. So we're going to take the new monthly payment times 6 months, and that's got to be in reserve. So when you look at it, when you look at the necessary funds for closing, you don't have to remember all this, that's our job. But just so that, if somebody says, I want to buy $1 million home, and they've got $1 million, it's going to be shaky as to whether or not they can get this. Why? They got to have the down payment. Well, that's going to take away from their $1 million. Then they've got to have enough money to cover the loan amount. So let's just use in this case, let's say the loan amount's $1 million. So they've got to have the $1 million sitting in the account. They've got to have take their monthly recurring debt times 60. That's got to go into the account. Then we have to have 6 months of reserves. Whatever that new monthly payment is times 6, that's got to be in the account. So again, it could vary. It could be as little as like 1.1 million. If they're getting $1 million loan, it could be as much as $1.5 million. Depends on their situation. But if people have got a lot of money and they can't prove their income, like this one couple that we're doing right now, they can still buy the property. The other interesting thing is they can get this with a credit score down potentially as low as 600. Now the one that we're doing is like 650, which they're going to end up with a relatively high rate, but they want the house.
Do you see that often, somebody with that low of a credit score with that much assets?
No, but we do see it, yes.
So besides like Warren Buffett, who would this loan be good for? Just somebody who doesn't necessarily show income because of being a small business owner or investment?
Oh, like this particular couple, they sold a business a couple of years ago. So they have millions of dollars in the bank.
But there's no income, so they can't.
There's no income. So the only income they have is the income off of their investments, which is nowhere near going to cover because of the way they've got their stuff structured.
Gotcha.
So there's a lot of people in the situation. You and I don't realize it because we may not run in those circles. I don't. But I know, I've seen enough of it. There is a lot of money out there. And people that can't necessarily prove that income. Hey, take a look at some sports figures. Somebody gets a great big huge contract, or a big signing bonus. So now they want to go buy a big house, but they don't have a contract that's going to take them what we call a continuance for 3 years. We don't have that. So this becomes a loan that they could use. So there's lots and lots of people. I think the most important thing is when you have somebody who says, I can pay cash for this, I just don't know if I can prove all my income, it should raise that green flag that says, let's talk about the asset-based loan. It is a fabulous loan. And the thing is, this is not by any means subprime. You got to bear in mind, these people have a lot of money. And we're verifying all of the money. It has to be their money. It's got to be seasoned for 6 months. But they've got all this money. They want to buy the house. Okay, buy it. If you've got $5 million in the bank and you want to get a loan for $1.5 million, we'll give it to you. Why wouldn't you? Especially if you're going to pay some crazy interest rate, 5, 5.5, maybe 6, maybe 4.5, depending on your credit scores. So there's a lot of opportunity. And again, in my opinion, a lot of this is not so much that you and I are going to go run out and do this loan. But what it does, it gives us conversation. Some of you put it on video. In some cases, it's just conversation. It gives you something else to talk about when you're speaking with your client or with a group of clients or on video, whatever it is. Talk to people about their options. They may not know about it. Interesting thing is, in a lot of cases, they may not need it, but they may know somebody who needs this product, which is now a lead for you. And that's where these things become valuable. So I would strongly encourage that you give consideration to that. It's not so much, I don't know anybody in that bucket. Don't worry about it. It's conversation. And it could lead you to another loan that lead you to another transaction you otherwise wouldn't get. It might just be a normal transaction, but who cares? All you want to do is get another deal, right? Questions?
This can be primary and secondary?
No, just primary.
Even if it's not investment, it can't be.
No, it's got to be primary resident. Yep. Anything else? All right, well, hey.
A little off topic, do you do those, are you familiar with those USDA single close new construction loans where it's like 0% down?
I'm going to answer that by yes and no. I've been doing USDA loans forever, and it's 0 down. Now, We are not doing a USDA construction loan. I've done more than my share of new homes that we did a USDA loan on. But the builder sold it to we didn't do the construction financing.
Gotcha.
If that exists, I'm not even aware of it. Maybe it does, but I was unaware that there's a USDA construction loan product. But USDA, as you've heard me say before, is one of the best products on the market.
Right.
Ratios are tight. They're not as loosey-goosey as it is with FHA, VA, and conventional, but the loan itself is outstanding. All right? Well, hey, everybody, have a wonderful, wonderful Thanksgiving.